Are we facing an earnings recession, or are we facing a real economic recession?
Well, I mean, I think certainly there are reasons to think earnings will be under pressure because of oil as they were back in 2015. I mean, you also had a much stronger dollar in relative terms in 2015. The dollar is up a bit right now, but not up as much as it was year over year back in 2015. So those are two key aspects for earnings, which are different from the share for overall GDP. I mean, I think growth is clearly poised to slow a bit here. And that's the question we're all grappling with. I mean, when you look at the tightening of financial conditions, some slowing in foreign growth, we're probably going to get some fading of fiscal stimulus in 2019. There are a lot of good reasons to think that growth will be slower this year. But I mean, I think in the end, it's going to be a moderation in growth, not a collapse. But of course, that's what we're all dealing with. And I mean, as the markets come down, there's the question to what extent the decline in confidence in the markets feeds into confidence on Main Street and corporate America. And where does all that end? I mean, personally, I think the gloom has gone a little too far here. But there are a lot of moving parts nonetheless. But I think in the end, we get moderation in growth rather than a collapse, and not necessarily even an earnings recession. I mean, I think if you can get kind of 2 to 2.5% GDP growth, I mean, you can probably still squeeze out some earnings growth out of that.
Michelle, what should we expect to hear or hope to hear from Jay Powell today and any of the other Fed officials who are going to be speaking through the course of the day? Yesterday, one Fed official who already thought we should be a little more cautious about things, reiterating that was enough to kind of slow the market's declines yesterday.
Right. I think that the problem with the Fed has been that the messaging up till now hasn't really changed probably enough. I mean, in December, the Fed acknowledged that there was slowing, things had cooled, but yet we're going to still continue to hike interest rates. So I think that you've got to see an acknowledgement that the situation has changed and the Fed has moved very clearly from a kind of autopilot once a quarter to, well, let's wait and see. We're not predisposed about whether or not we have to go.
It sounds like fine-tuning, though, because they keep saying we're data dependent. They keep saying something like that. The market wants a clearer signal that, yes, we have noticed that there is a change in the economy out there, and we are on guard about that.
I don't think that's asking a lot. What you just asked for is not asking a lot. I don't know why is there
close to what they have said.
No, they're going 2 more, and they're on autopilot. Why can't they just say we're going to wait?
Like, get rid of the dots.
Why didn't they do it? Yeah, get rid of the dots.
Right. And
Why
they
didn't they say
the language in December to remove the statement that we were kind of thinking they'd take out about expecting further increases, just to sort of make it that there's not a predisposition about continuing to move now that you're sort of into that neutral range. And I think that is what would reassure the markets.
I think it's more of a question of noticing the markets rather than the economy, because the economic numbers for the most part have held up pretty well. I mean, there's been some slowing in housing for sure, and the ISM yesterday was a bit more moderate, but 54 is not weak. But I think the issue is more financial conditions. What you'll hear from Powell today...
That's a stretch, because he has gone out of his way to try and say we're not going to be
no, he does say financial conditions matter, and he even said at the press briefing, but I think he'll emphasize it more. I mean, they look at economic conditions. Data dependency is also a function of dependency on financial conditions, because financial conditions feed back to the economy. Right. Now, if it's just volatility and the markets go up and down 5%, it doesn't matter. But if it's a sustained move in markets and you get a 10, 15% drop in the equity market and credit spreads are up 50 to 100 basis points, that does have consequences. Elections have consequences, but so do markets. And I think partly when you look at the ISM report yesterday, what you're seeing is the knee-jerk reaction to a big drop in the equity market. It affects sentiment. And then how much does that affect the economy?
If you have a Fed that you're paying to try to do the right thing all the time, shouldn't they be using leading indicators? Every Fed in the world uses lagging indicators. And they're always behind the curve. They're always using what they know now or what they know from the last 3 months or the last quarter. They never use leading indicators. Therefore, they're always on the wrong side.
Yeah, I think most Fed officials would strongly disagree with that.
Well, then why don't they use the market? Markets are leading indicators.
Yeah, so
they're in the economic.
They are looking at markets. They do care about financial conditions. I mean, Powell mentioned financial conditions a few times in his press briefing, and they will take that into account when they stuck the line into the statement about monitoring economic and financial foreign developments. Financial markets, that's what they're talking about. If financial markets move enough that they become more restrictive, then that does the job of.
But if we don't know why the markets, if it's 9 months, 6 months, whatever it's discounting, if you don't know for 9 months and they're looking and raising based on either what's happening now or what's happened in the past, how are they ever going to be ahead? How are they ever? Why do they always make mistakes, Jim? Why do they always make mistakes?
Well, everybody makes mistakes. And if you look at the last 2 years, I mean, a lot of people would have quibbled with them 12 months ago. Should they have kept tightening? And here we are with a 2 3/8 Fed funds rate, and people are worried about policy being too restrictive. I mean, I think there's probably been a bit of an overreaction.
We've got negative
myself.
rates in Japan, and we've got 17 basis points in Germany.
And markets are always going to move faster and overshoot relative to what the Fed can do and even what the economic numbers can do.
And
right?
swing back
It
and
should be a
forth.
flag.
But the truth is actually we've sort of crossed over a bit now, I think, with the ISM doing what it did yesterday.
Yeah.
I mean, it's one thing for the Fed to say we're going to look at kind of financial market movements with a bit of a grain of salt. I mean, we're going to take the messages there, but we're going to marry that with what we're seeing in terms of the economy. And up until now, the economy was showing relative resilience in the face of what equities were doing. And now we've had a sense that that's starting to change.
Show us.